Hello guys, once again welcome to our YouTube channel Edu Hub, and as you know this part 5 of stock market investment for beginners, so please don't forget to share and like our video. And guys, my every videos it's take time and come on 6 or 7 days, because guys my videos is so much long, as you know it will take time and hard work also, so please subscribe our channel, and without wasting time let's get started. Stock Market Investment for Beginners Part 5.
So we take on our first technical indicator, that is the on balance volume. And we know where to look for these indicators. We go to investing.com or whichever website you may prefer. So what you see on top over here is the normal candlestick chart. These bars are displaying the volume, and what you see below here, this graph, the line graph, what you are seeing, this is the on balance volume graph. Now this was developed by a gentleman called Joseph Granville sometime in 1963. And when he developed this, probably, they may have had to calculate things and plot the graph. It must have been a complicated process. But nowadays you don't have to do that. We have seen earlier that you go to the drop down menu in that website investing.com, and from there you just select OBV and the graph will come down. As the candlestick chart keeps progressing, this graph of OBV will also keep on progressing simultaneously. Alright, now let us see what this graph tells us. It says, or rather the theory of Joseph Granville says, that if the OBV is increasing when the price is stable or going down. Try and understand this. He says when the price is stable or going downwards, if that time the OBV is increasing, then eventually the price will also go up. Alright, if OBV is going up when the price is stable or the price is going down, then eventually the price will also go up. Similarly, he says that if the OBV is decreasing when the price is stable or going up. Try and understand. If the price is going up or the price is stable, at that time, if the OBV is decreasing, then eventually the price will also come down. Little confusing. Let me explain to you with some figures. Alright. Let us say that the OBV or the on balance volume is going up, and at that time the price is also going up. Now this is a normal thing, nothing surprising about it. We have already seen earlier when we just saw the first lesson of the technical analysis. If the volumes are increasing, more number of people are buying, so obviously the price will go up. There is nothing new or nothing great in this. Similarly, if the on balance volume is going down, more number of people are selling, so the price will come down. This is also normal, nothing great, nothing unusual in this. But if the on balance volume is going up and the price is coming down or the price is stable, if such a thing is happening, then this is not normal. The price will eventually go up. The OBV is going up, then the price will also eventually go up. This is an abnormal situation which is happening. So a technical analyst has to take a hint from this. Similarly, if the on balance volume is going down when the price is going up or the price is stable, again this is not a normal situation, not a normal occurrence. Here again, eventually the price will go down in tandem with OBV. Alright, now coming back to the graph, let us have a look at the graph. What is happening here, you see, this is the on balance volume graph. see from this point to this point, the OBV is coming down. Can you see this? And at the same time, see from this point here onwards, see this point, generally the price is also coming down. So they are in tandem. Nothing great, nothing unusual. So we are not concerned with this. Alright. Similarly, you see here the on balance volume is going up, and during the same period, see from here to here, the same period, the price is also going up. Normal thing, it has to happen, nothing great in this. So this also is not of our interest. But now look at this portion here. The on balance volume is coming down, but see the price is going up. All right, they are in divergence. Of course, the price is coming down also. Here it came down, then again went up, then came down, then went up. But if you see the general trend here, it is going up, while the on balance volume is coming down. So this is not a normal situation. A trader will detect this. He will get a hint that sooner or later the price will also start coming down. So here the price has started coming down. All right. Now it is very easy for me to say in retrospect after seeing the graph, when the graph is complete. But for a trader, it is a matter of experience. It is rather impossible for anybody to tell that from here it will start moving down. It doesn't happen like that. But an experienced trader who knows enough, who has practiced enough, would know somewhere here itself, as this on balance volume start going down and the price has started going up, he would be on his toes. He would, get alert that something wrong is happening. Now sooner or later the price will also start moving down. So he may take a decision somewhere here. See, people started taking decision here, came down, but again started going up, again it came down. So the traders know, but at the same time, there are both the parties, the for and the opposite party. So some people trying to bring it up, then again coming down, then some people trying to bring it up. But eventually, the price will follow this OBV. Got the point? So either here, somewhere, or when it starts coming down somewhere here, a trader would take a call depending upon his luck, his experience, his knowledge. At some point, he'll take a call or decide when to sell, and then see this OBV and the price both come in tandem. So I hope you generally understand the concept of this on balance volume. All right. Welcome back. Now let us have a look at the second technical indicator, and that is called as accumulation distribution. And where to look for the indicators? You go to investing.com or any other website of your choice, and you can have a look at the indicator. So what you see on top over here is the normal candlestick chart, and below this graph, paint graph, what you are seeing, that is called as the accumulation distribution graph. Now again, in earlier days, people may have had to calculate and plot this graph, but in the modern times, it is all done by the software. You go to the website, just select in the drop down menu, and the graph will come in front of you. As the candlestick chart keeps progressing, this graph will also keep on progressing. Let us try and understand what it is. See, accumulation, a simple English word. Accumulation means people are accumulating, people are buying. Alright. So when people buy, the price will increase. It has to increase, isn't it? We have seen earlier, when a lot of people are buying, number of buyers are more than the number of sellers, then the price will increase. Nothing great in this. This is a normal occurrence. Alright. Similarly, distribution. Distribution means people are selling, they are giving away, they are selling. And when a lot of people start selling, there are less number of buyers, then the price will fall, isn't it? Again, nothing great or nothing unusual in this. So this, when the graph is moving up here, that is accumulation. People are buying When it goes down, that is distribution. So far understood? Nothing great, nothing unusual here. But imagine a situation when people are buying, that means people are accumulating, but still the price is going down or the price is falling. Or people are selling, that means distribution is happening. People are distributing or selling in large numbers, but still the price is going up. If such a thing happens, then that is something unusual. That is interesting. A trader would detect such a signal because he knows that eventually after some time the price will change direction and start moving in tandem with accumulation or distribution. If accumulation is having, then the price will start moving up, or if distribution is happening, then eventually the price will start coming down. Let us have a look at this graph here. You see from this point the slope is downwards, that means distribution is happening. People are selling, distribution is happening. So when distribution is happening, the price should have been coming down. But here an opposite thing is happening. You see from this point, as people are selling, distribution is happening, but the price is going up. Something unusual. So a trader is on the lookout for such a thing because he knows that if the price is going in the opposite direction, sooner or later the price will change direction and start moving in tandem with accumulation or distribution. So if distribution is happening here, then the price will change. So here you see the price has changed from here and the price has started coming down. Alright. But now it is very easy for me to explain this graph in retrospect. Once everything is over, I can look back and explain. But for a trader, it is very, very difficult to decide that when the direction will change. It will depend upon his experience, his wisdom, and how much risk-taking capability he has got. A normal trader, a person who has learned freshly, he would look here. He would see that distribution is happening. From here, the slope has started coming down, but here the price has started moving up. So very soon, somewhere around here, see these points, somewhere around here, a fresh graduate or a person who has just studied will take a decision of selling here. And then he will incur losses because the price is still going up. Some people may take a decision at this point, and for some time the price has started come down, he will benefit. But suddenly you see this sharp rise, suddenly the price has gone up. Alright, and from this point onward is the actual price which has started coming down. So a trader who have had the patience of waiting from this point to this point will actually reap a lot of profit by selling at this point. Alright, but as I have told you earlier, that normally a good trader will not take decision based on a single indicator. People will look at 3, 4 or 5 indicators and also the candlestick patterns, and when everything tells them the same thing, all the indicators what they are following, all of them or a majority of them, when they say one thing, then they will follow that direction. For example, if they are following 5 indicators and 4 out of 5 tell them that the price is likely to go up, they will believe that the price will likely to go up. But if out of 4 or 5 just 1 or 2 are telling them, then they may not believe that indicator. Alright, so I hope you have understood the significance of this accumulation distribution. This was a very, very odd case which I brought in front of you, just to explain that one should not be in a hurry to take a decision. It has taken quite a long time from here to here for the price to start moving in tandem with the accumulation distribution pattern. Got the point? So we have talked about fundamental analysis and technical analysis. That means about the investor as well as the trader. And now we shall talk something about risk management and derivatives. You see, when we talked about investor and the trader, an investor does fundamental analysis and he puts his money into the stock market for a longer period, minimum 1 year, but generally it is for much more than a year. Alright? And a trader does technical analysis and he is putting his money for shorter periods, maximum up to 3 months. At times, a trader may put money for short duration as short as 5 minutes, 15 minutes, 30 minutes, but never for more than 3 months. If his money is held up for more than 3 months, then he would fall into the category of investor. Alright? The analysis conducted by an investor, the fundamental analysis, can go wrong at times. So also the analysis conducted by a trader, the technical analysis, can also go wrong at times. But the issue is that an investor can afford to absorb some notional losses, the losses which are only on paper seen on his computer screen. He keeps holding to his stock positions with notional losses and he can afford to wait for a longer period for the prices to recover and come back to the normal or appreciate much more than what he has invested. But in case of a trader, it is a different matter. For him, it is a matter of regular earning. He has to keep buying and selling to make a regular earning. So he cannot afford to wait beyond 3 months. Alright? Therefore, an investor is not worried about the notional losses. When he is having notional losses, he doesn't lose his sleep. But when he earns a profit, when his computer screen shows profit, and if that profit is much more than what he was expecting, then he gets little anxious and he wants to protect his profit. How does he protect his profit? He does it by hedging, and for the purpose of hedging, he uses derivatives like futures and options. Alright? But a trader has to constantly protect his position. Whether he has purchased shares or sold them, whether he is long or short, he has to constantly protect his trade because he cannot afford to wait for long to recover the losses if at all they are there. And how does he manage his risk? He protects his trade or he manages his risk by the use of stop loss and derivatives like futures and options. Alright. So now we have learned a few new words: hedging, stop loss and derivatives like futures and options. Now all these things I have explained in detail in my other courses like the derivatives part 1, derivatives part 2 and simple trading strategies. Both these are 6-hour course and this one is about 2.5 hours. So obviously I cannot repeat the content of these courses here, the entire course. These are specially focused courses. What we are now talking about is a general comprehensive knowledge. Alright, so obviously I cannot include all these things. But what I have done is, for your basic understanding, just to explain to you as to, just give an idea about hedging, derivatives and all these things, I have attached some extract lessons from these courses. After we complete this lesson, the next few lessons are just the extract from these courses. Alright, I have not reframed them or not re-recorded them. I have just taken an extract from there and inserted here just for the sake of giving you some basic knowledge. Alright? Alright, let us see one more technical indicator, and that is MACD, or the moving average convergence divergence. What it is? A moving average convergence divergence is a trend following momentum indicator. that shows the relationship between 26 period exponential moving average and 12 period exponential moving average. Understood nothing? Alright, let me explain. What it means is that it follows the trend. MACD is an indicator which follows the trend and which indicates the momentum. And all this English what is written here, actually it says how it is calculated. So how it is calculated? Step 1, what you do is you calculate a 12-day period exponential moving average of the closing price of every day. What is this exponential moving average is another topic altogether, so just don't bother about that at the moment. Then step 2 is calculate the 26 period exponential moving average. It is A actually, not S, exponential moving average of the close price. Then step 3, you have to subtract the 26 period moving average from the 12 period moving average, and then what you get is the MACD line. Step 4, again you calculate the 9 period exponential moving average of the fast MACD line. This is the fast MACD line what you get. Of this you calculate, and then what you get is the signal line or the signal MACD line. Again, very complicated. Why I have written here is just to show you how complicated it used to be in the earlier days. But nowadays you don't have to worry. You don't have to do all this calculation because the software does it for you. All that you have to do is go to the investing.com or any suitable website. Alright, select drop down menu and there you go and select MACD. So you will get this in front of you. What you see here is the normal candlestick chart, and what you see on the bottom is the MACD. See all this 12 period exponential moving average, 26 period exponential moving average, and this 9, everything is calculated automatically and it is plotted here. As the candlestick graph keeps moving with the passing of time and days, this graph of MACD will also keep on moving accordingly. You don't have to worry. Everything is calculated by the software and displayed in front of you. All that you have to do is look at them and analyze and take your decision depending upon your own analysis. Alright. So what you see here, this blue line what you see, this is called the MACD line. It has arrived from all this calculation which we talked about. So this blue line is called as the MACD line, and this red line that you are seeing is called as the signal line. These two lines are important which we are following now. Alright. Now have a look at this. Here where the blue line or the MACD line crosses and comes down, it comes below the red line, below the signal line, it indicates a sell signal. Here the trader would understand that this is the point where I must sell. So look here on top, okay, see this corresponding point you can see. From here the price has started coming down. Now don't look for precise things. See, the price actually had started coming down from here. Alright, see from this point where the blue line was already above the red line. So the price has started coming down from this point. And actually where the crossover has taken place, the price has actually started going up. So the market is behaving in a way to challenge the trader and confuse him. But if the trader knows his game well, he will understand that somebody or the big players in the market are trying to play a trick with me. So he will stick to his guns and see very soon here the price has started falling again. Alright, see this big move. There was only a small move upward here just to confuse the trader. An amateur trader who is not very experienced will get confused and he will exit at a loss. But a seasoned player will stick to his guns and wait for the price to come down. depending upon the signal which has been given by the MACD line. Got the point? Then you see again this point, alright, this arrow I'm just indicating that it has started coming down. Okay, now this red line and the blue line here, when the blue line crosses and goes above the red line, that is a signal for buying. Got the point? Here when the blue line crossed over and came below the red line was a signal for selling and the price started coming down. Here when the red line goes below and the blue line crosses and comes above the red line, that is a signal for purchasing. A seasoned trader knows that now is the time for me to purchase. So look at this point here. See this point, corresponding point, you see how a sharp move has come. Then again the price started falling. Again the market is behaving in a way to confuse the trader. It has come down for some time, but then again it has started going up, and see how much volume or how much for number of days or period which it has gone up. A small dip here just to confuse the trader. If he is an amateur trader, he'll get jittery, he will panic, he will exit. He will think that I have taken a wrong decision here. The blue line going above the red line, a buy signal. So a person would buy in a haste here, see the up move, and as soon as the price starts coming down, he'll get jittery, panic and sell off. But a seasoned player will remain, stick to his position and see the amount of profit he would gain, how much it has gone up. Alright. Then again you see here, when the blue line comes down, it again starts coming down. Okay, see it is coming down here, blue line is below this. Again here at this juncture, it goes up suddenly for a short duration. See the crossover, the blue line has come above the red line, so the price has started moving up. Alright, then again at this point, though the blue line is above the red line, but still it has started falling. And here when the blue line crosses, comes down, then the downward movement continues. So at some places you find that the market is not following the technical indicator, and obviously the market is not bound to follow the technical indicator. As the example I have given you earlier, technical indicators are not the law of nature. An apple falling from the tree is bound to come down to the ground because that is the law of nature. But in this case, the technical indicators are not the laws of nature. Market is not bound to follow them. So even if 7 out of 10 times they give you correct signal, that should be good enough for a person to make adequate profit. I hope you understand that point. So we have seen 3 technical indicators so far. One was the on balance volume or the OBV. Then we saw the accumulation distribution. And then we saw the moving average convergence divergence or the MACD. Quite an interesting topic. But as you know, this course is not about specialization in technical analysis. This course is basically what I am trying to give you is a comprehensive knowledge or a broad knowledge of the stock market investment and trading, as the name of the course indicates. We are not specializing here in technical analysis. So therefore, I cannot continue with all the 79 indicators here. We shall end the technical analysis portion at this point of time by reiterating the fact that technical analysis is only an analysis. It is based on some past study by experts, their theory, and some probability of occurrence. The laws of nature cannot go wrong. The laws of nature will always be right. As we said, an apple falling from the tree will always come down to the ground. But technical analysis can go wrong, and at times they will go wrong. So just remember that even 7 out of 10 times if you are right, you should be happy. Alright? So to begin with, let us try and understand the meaning of the word derivative. because once we understand the meaning, then it will become easy for us to understand its application. So literally, derivative means derived out of something. For example, the curd is derived out of milk, or you can say that the curd derives its value from the value of milk. If the price of milk increases, then the price or the value of curd will increase, and similarly, if the price of milk reduces, then the price or the value of curd will also reduce. Another example could be a gold necklace. You can say that the gold necklace derives its value from the value of gold. If the value of gold increases, then the value of the necklace will also increase, and vice versa. So for that matter, a derivative contract like a futures or options, they also derive their value from an underlying asset. And that underlying asset, like here the underlying asset is milk or the gold, that underlying asset could be a share of a company, it could be the currency of a country, or it could be a commodity, or even an index like Nasdaq or Nifty or the Dow Jones. Now let us see some real life examples of derivatives. So as I have told you, on one hand there is an underlying asset like the milk or the bar of gold, and on the other hand there is a derivative of the same thing. Now I have written here that the underlying asset is real and the derivative contract is notional. Don't worry about this. I will explain the meaning of this towards the end of this lesson. For the time being, consider that a single share of Tata Motor is an underlying asset being traded on the exchange at $20 per share. On the other hand, you have a notional basket containing 1000 shares of Tata Motors. Now this basket may be considered as a derivative of this Tata Motors share. Why a derivative? Because the value of this basket will depend upon the value of Tata Motors share or the price of Tata Motors share. If the price of the share increases, the value of this basket will increase. If the price of the share decreases or goes down, then the value of this basket will go down. Consider another example, a currency like a dollar. A dollar has got some value in relation to other currencies like the yen or the real or the rupee or euro, whatever. Alright. And on the other hand, there is a bundle of this currency, the same currency, maybe containing $10,000 or $20,000, whatever. This bundle may be considered as a derivative of this currency because the value of this bundle depends upon the value of this underlying asset with respect to any other currency. If the value of the dollar with respect to other currencies change, then the value of this bundle with respect to other currencies will also change, isn't it? Consider a single barrel of crude oil and a consignment of 1000 barrels of crude oil. This consignment again may be considered as a derivative of this 1 barrel of crude oil because its value will depend upon the value of this oil or a single barrel of oil. Same is with the case of another commodity or say grains or pulses. This consignment of 1 ton of wheat is a derivative of 1 kg of wheat. If the price of 1 kg of wheat changes, then the price of this consignment will change. So what you have to remember is that the value of the derivative contract will depend upon the value of the underlying asset. I have adequately explained this. Another most important thing that you have to remember is that the underlying asset is a real thing. But this derivative contract is not a real thing. It is only imaginary. It is just a promise or a contract. Why it is imaginary? Because when you are trading in derivatives, you are not physically exchanging those things. Alright, you are just exchanging a promise. More about this we will see as we proceed through the course. But for the time being, just remember that this derivative contract is notional. You do not physically exchange these things, you only exchange a promise or a contract, and that promise has got a validity period, maybe 1 week, 1 month, 3 months, but that promise does not remain valid for eternity, but this underlying asset remains for eternity. All right. And the third thing is that if you want to sell the underlying asset, like for example, if you want to sell the Tata Motors share or the barrel of oil or anything from this, you must first possess it. Only if you are having this underlying asset, you will be able to sell them. That means if you want to sell a share, you must first buy a share and then only you can sell it, isn't it? But that is not so with the derivatives. Since derivative is not a physical thing, it is only a notional promise, you can sell them without possessing them. Even if you don't have this derivative, you can still sell them and purchase them later. For example, today if you feel that the price of Tata Motors share is going to go down in the days to come, and therefore the value of this basket is going to go down, in that case you can sell this basket today even without possessing it, and later when the value actually goes down, you can repurchase it at a lesser price and thus make a profit. So that is the concept of derivative. I hope that concept is clear. Let us try and understand what are stock futures or future contracts. Alright. So let us say today is 1st of April 2021. Just hypothetically for the sake of understanding. And today the shares of Tata Motors are trading at $20 a share at the stock exchange. Tata Motors is an automobile company, alright? And let us imagine a notional basket, an imaginary basket containing 1000 shares of Tata Motors. Just an imaginary basket, alright? It's not a real thing. So if the Tata Motors share is costing 20 rupees a share, then this basket of 1000 Tata Motors shares will be valued at $20,000. Isn't it? Okay. So this single share of Tata Motors is called as the underlying asset. And since this notional basket derives its value from the share of Tata Motors, because if the value of the share or the price of the share goes up, then the value of this basket goes up. And if the price of the share goes down, then the value of this basket goes down, an imaginary basket. So therefore, this imaginary basket is called as a derivative of Tata Motors shares because it is deriving its value from the shares. We are not saying whether it is a future or an option. At the moment, we are just saying it is a derivative. It could be anything. All right. Now, if something is to be traded in the market, then there has to be a buyer and a seller. If you want to buy something and if there is no seller for that thing, then you cannot buy. And similarly, if you want to sell something but there is no buyer for that thing, then you cannot sell. So for a transaction or a trade to happen, there has to be a buyer and there has to be a seller. So let us consider that there is a buyer and there is a seller in the market for this notional basket which does not exist in reality. All right. Now the buyer believes that the price of Tata Motors share is going to increase in the days to come. And therefore, if the price of the Tata Motors share increases, the value of this notional basket will also increase. Therefore, the buyer wants to buy it. And on the other hand, there is a seller who believes that the price of this Tata Motors share is going to go down in the future or in days to come. and therefore the value of this notional basket will also go down. So he wants to sell this notional basket. Remember, this notional basket belongs to no one, alright? It is just an imaginary thing. So the buyer tells the seller that I understand this notional basket does not belong to you, but still if you are willing to sell it, then I am willing to buy that imaginary basket now at $20,000. If the price goes up, I gain, and if the price goes down, then I lose. Alright? At the same time, the seller tells the buyer, okay, I know that the notional basket does not belong to me, but still if you are willing to buy, then I am willing to sell that imaginary basket at $20,000 now. If the price goes down in future, then I gain, and if it goes up, then unfortunately I lose. Alright? So now both of them enter into a mutual promise. The buyer is promising this to the seller, and the seller is promising this to the buyer. And this promise is called as a futures contract. See, nothing has been exchanged. This basket is only imaginary. They have just exchanged a promise, and that promise is called a futures contract. And how long will that promise remain valid? That promise remains valid till the expiry date. And let us say that 29th April 2021 happens to be the expiry date. So on 29th April 2021, this promise will expire, and this imaginary basket, which as it is not there, will be forgotten. Alright. So now let us see what happens on 29th April 2021. The buyer and seller have now entered into a contract, a futures contract, by exchanging a promise. Alright. So now let us see, the buyer and the seller are there only. On 29th April, we find that the price of this Tata Motors share has increased from $20 to $21, and therefore the notional basket's value has increased from $20,000 to $21,000. So what has happened in reality? The buyer has gained $1,000 because he had bought at 20, now it has become 21. So he has gained $1,000. But the seller has lost $1,000 because he had sold at 20. Now the price has increased to 21. So he has to repurchase at 21. Alright. So he has lost $10,000 or $1,000. I correct myself. Now let us imagine a situation that suppose instead of increasing, let us say the price had come down to $19. The price of this underlying asset or the Tata Motors share had come down to $19. In that case, the value of this notional basket would come down to $19,000, isn't it? So what happens now? The buyer loses $1,000 because he had purchased at 20. Now the price has come down to 19. So $1 per share, that means $1,000 over this basket he has lost. And what happens to the seller? The seller gains 1,000 rupees because he had sold at 20. Now the price has become 19, so he can repurchase at 19. Alright, he has gained $1 per share. That means he has gained over this basket $1,000. Alright, and what happens? In either of the case, whichever party wins, whichever party loses, the promise ends on 29th April and this future contract expires. Alright, and this notional basket, which never existed in the first place, it just vanishes into thin air and is forgotten. And ultimately, this future contract is a zero-sum game. Why zero-sum game? Because whatever one party gains, the other party loses. Irrespective of if one party is gaining, the other party loses. Now imagine a situation that on 29th April, the price of the underlying asset, that is Tata Motor share, would have remained 20. So in that case, the buyer would have been at a no profit, no loss state, and the seller also would have been at a no profit, no loss state. What I have explained to you now is basically a futures contract or a stock futures. I have not explained to you as to how it is traded. Hi. So we begin with our first lesson on understanding options. But before we talk about the word option, we need to understand the meaning of the word, the literal meaning, as well as the meaning in context of what we intend to do. So if you ask me the literal meaning of the word option, it means a choice. If you ask me for example of choice, then it could be, you can choose between yes and no. You can choose between right and wrong. You can choose between true or false. You can choose between good or bad. Similarly, a choice could be to do a thing or not to do a thing. For example, would you like to go to office or would you not like to go to office? That is a choice. Would you like to go for a movie or would you not like to go for a movie? That is a choice. All right. And if a choice is to be traded in the market, if there is a marketplace for a choice, then there has to be a buyer of the choice and somebody has to sell the choice. You see, if you want to buy something, then somebody should be willing to sell that thing. And similarly, if you are trying to sell something, then there has to be a buyer for that. Only then can the trade be executed, isn't it? Now let us say that the choice which is being traded in the market is a choice to do a thing or not to do a thing. All right. What is that thing? Forget for the time being. Soon we will understand. And let us assume that you are the buyer of the choice and I am the seller of the choice. We are in a marketplace. I am selling choice and you are buying a choice of doing something or not doing something. All right. So as a buyer, you have got the choice. If you want, you will do the thing. If you don't want, you will not do the thing. And as a seller, I take the responsibility that when you want to do the thing, I will allow you to do the thing. All right. That is my responsibility as a seller of the choice. Now to get a choice for doing a thing or not doing a thing, the buyer of the choice has to pay a small premium because he is at an advantage. He is getting a choice. So he has to pay a small non-refundable premium. And I, as a seller of the choice, will receive that premium because I am taking the responsibility of ensuring that you have the way of doing your choice or doing what you want. All right. Now comes the time at a later date to exercise the choice. The buyer or you as a buyer have got the choice of doing the thing or not doing the thing. But you will do the thing only if circumstances are favorable and you are gaining something out of it. If you are losing, then you will not exercise your choice. If you are losing, then you will say, I don't want to do the thing. I have the choice of not doing it. So I will not do the thing. Isn't it? Only if you are gaining something out of it, you will exercise the choice. Otherwise, you will forego your choice. Isn't it? Now, from the seller's perspective, I as a seller of the choice, I will always want that circumstances should not be favorable for you to exercise your choice, so that you forego your choice and I retain the premium which you have given me. But if circumstances become favorable for you and if you exercise your choice, then whatever you are gaining by exercising your choice, that much amount I would be losing. All right, just try and understand the meaning of it. I know you would be getting a little confused, but that is how the topic is. Initially it will be a little confusing, but as we proceed, things will become more and more clear. All right, so as a buyer of the choice, your scope of gain is unlimited, but the loss which can incur to you is only limited to the amount of premium which you have paid. And similarly, for me as a seller of the choice, my gain is limited to the premium which I have received from you, but my loss can be unlimited if the buyer of the choice chooses to exercise his choice. All right, now what is the thing for which the choice is being bought or sold? What is that thing? What choice are we buying and selling? In a stock market, is it the choice of buying something or selling something, like buying a share or selling a share? Is that the choice? Unfortunately, most of the people think and believe that the choice is between buying something or selling something, buying a share or selling a share. Unfortunately, no, it is not. The choice is not between buying and selling. Then what is the choice? The choice is between buying a thing or not buying a thing, buying the share or not buying the share, and selling something or not selling something. You see, there is a difference between this choice and these two choices. Here, the choice which you are giving a person is either you have to buy or you have to sell. But in the stock market, it is not so. When you trade in options, it is not so. The choice is whether you want to buy or you don't want to buy. And the second is whether you want to sell or you don't want to sell. Understood the difference? Now this choice, when you are offering somebody a choice of buying or not to buy, is called a call option. CALL, call option. All right. So when you think of a call option, it is the choice between buying a thing and not buying a thing. And if this is the choice, then there has to be a buyer of the choice and a seller of the choice. Don't get confused. It will become clear in a moment. All right. And similarly, if the choice is between selling a thing or not selling a thing, that choice is called as a put option. When you talk of put option, that means that is a choice of selling a thing or not selling a thing. And again, if this choice is being traded in the market, if a put is being traded in the market, then there has to be a buyer of this choice and a seller of this choice, isn't it? So you have a buyer for a call option and you have a seller for a call option. And similarly, you have a buyer for a put option and you have a seller for a put option. All right. So let us begin with understanding the meaning of the word hedge. Now we all know what we see here in this figure is basically a hedge. And what is the purpose of this hedge? why have I built this hedge around my house? The purpose of this hedge is to protect my property and my lawn, which I have developed over a period of time with lot of effort. I don't want my lawn, my house to be destroyed by outsiders or by stray cattle, and therefore I have built a hedge. Now in financial derivatives or in stock market, the hedge is doing the same task or the same purpose it is serving. It is protecting your portfolio or your investment. But the difference is that here when I have made a hedge, it is once and for all. But in the stock market, I have to make a new hedge as and when I perceive a threat to my portfolio. So now if I see an imminent danger to my stock portfolio in the near future, can I protect the value of my portfolio or the value of my shares from falling? And if yes, then how can I do that? So the answer is yes, I can protect the value of my portfolio if I foresee an imminent danger, and I can do that with the help of stock derivatives. Now, what are stock derivatives? We all know that futures and options, and with a combination of buying and selling, we can do hedging in different manners.